Welcome, everyone. This is William Jefferson Black from the Transaction Advisors Institute. I'm really pleased to have Emilie Feldman with us today. She focuses on corporate strategy, governance, and in particular, M&A and divestitures. Emilie, welcome. Will you first introduce yourself to all of our members?
Hi, yeah, thanks so much. So happy to be here. Hi, everybody. I'm Emilie Feldman, professor of management at the Wharton School of the University of Pennsylvania. I've been a professor here at Wharton for 13 years now. Hard to believe, time flies when you're having fun. Before that, I did my studies at Harvard Business School and Harvard College. And as William just introduced me, my area of research is all around corporate strategy and governance, very interested in M&A, divestitures, the role of activist investors, boards of directors, and really the intersection of these two areas, right? Strategy and governance, and really thinking about how that plays out in large organizations. So very happy to be here today with all of you.
Well, and of course, what prompted our discussion today was the recent publication of the book Divestitures, which is now available. So we're going to have a chat today about some of the key observations that were part of the book and a part of your studies in preparing for the book. Certainly, as we look at plans and challenges that the board is going to be considering in 2023. Whether or not to take inspiration from the recent divestitures that have been announced at AT&T, at GE, of course, a three-way, at J&J, Kellogg's, and many others. They've all come with a sort of a general theme or promotion of both the strategic merits of pruning the portfolio and the pure value of optimizing capital and redeploying it perhaps for more constructive and strategic acquisitions. It's inspiring. And so as we think about this, should we all be inspired to think more regularly and more strategically about divestitures? But gosh, I'm so curious, why do corporate development teams shy away from divestitures?
Yeah, for sure. It's a great question, and it really is at the heart of the book. So I think that there's a huge stigma that, frankly, is wrongly associated with divestitures, right? So I think that the prevailing view or the conventional wisdom in many cases is, okay, we're divesting something must have gone wrong within our company, right? We did an acquisition that didn't work out, or we had a strategy that didn't pan out in the manner that we were expecting it to, or industry conditions changed, or there's underperformance, or you name it, but something has gone wrong. And so we divest as a reaction to that problem, basically. And so, I certainly will never deny that divestitures do happen for those reasons. Of course they do, right? But I think that there's a whole other side, and you started alluding to it a bit in terms of the examples that you were just talking about, the recent examples that you were just talking about. But there's, a whole host of very proactive and strategic reasons why companies might want to divest that have nothing to do with responding to problems or failure or underperformance. And so I think that, there's that stigma that's kind of wrongly associated with divestitures. But one of the main purposes of my book has been to say, well, can we reframe that conversation a little bit? Can we start to acknowledge some of these more proactive and strategic reasons why companies might want to divest and how they might add value to those organizations? So that's really a key theme in the book and in my research, and I'm happy to elaborate more on those points. But I think that's kind of a key distinction between sort of conventional wisdom versus what I'm bringing to the conversation.
Well, and I'm excited to peel that back a bit, and maybe to set the stage, if you could give us some context. So, in your research, most of our members are focused on acquisitions, right? But I don't think we appreciate or know what kind of activity exists in terms of divestitures, relative to acquisitions, and is that changing much over time?
Yeah, it's a good question. So, so the average number is that companies do, across all companies, if we look at the universe, right, companies do 2 to 3 M&As for every 1 divestiture. So obviously that masks a lot of heterogeneity, both across time, across different company types and sizes, so that's just kind of the big aggregate average effect that we observe. So, but if you take that, right, that's pretty striking. That means, kind of 20 to 30% of transactions are divestitures, 70 to 80% are M&A, right? So that's a big discrepancy if you think about that relative proportion. Putting it a little bit differently, one thing that I looked at for the research in my book was, let me just look at the S&P 500 and let me see what proportion of those companies in any given year do no divestitures. And so I was actually quite astonished by this figure, but the figure actually is that 70% of companies do no divestitures in any given year. And this is true going all the way back to the year 2000, right? So 20 plus years at this point. So I think that that's a really big number, right? That's a very striking finding, right? Even if you put aside sort of the 2 to 3 to 1 ratio that I was just talking about a minute ago, that, it's just not even part of the conversation in some sense in many of these, major organizations. So I think that just kind of adds a bit of kind of color and depth maybe to some of this distinction between conventional wisdom, stigma versus maybe some of these other motivations that companies might have in doing these transactions.
Sure. Well, yeah, now I'm starting to reflect too on the focus and emphasis of the Institute. A lot of our programs are on the buy side, right? And how to buy acquisitions more effectively. And do we need a more balanced, so we were already expanding the horizons of our thinking, which is helpful. But, part of this, you've talked about some of the strategic reasons to think about divestitures, but let's talk about dollars and cents here. So, if we look at sort of abnormal returns after divestitures, I mean, are these really meaningful transactions?
Very much so, and this is actually the great pathology, as I like to call it, when I compare M&A to divestitures, right? So come back to what I just said a minute ago, right? 2 to 3 M&As for every 1 divestiture. If you ask CEOs what they prefer or what they think is going to add more value to their companies, 70% of them say that, or 75% of them say that M&A is going to add more value than divestitures. 90% of them say that organic growth is going to add more value than divestitures, right? So there's this huge preference, right, is what I'm saying here in terms of activity and what we observe for M&A over divestitures. But then to your question, so I've crunched these data extensively over the years, right? And this is actually a big part of what animated, sort of the desire to work on these transactions and to study them and to understand them. If we look at abnormal returns, in fact, it's the divestitures that outperform the M&As, right? So we actually see sort of significantly positive abnormal returns upon announcements of divestitures relative to average 0 or maybe even slightly negative, depending on the year that you're looking at. Abnormal returns to mergers and acquisitions. And this goes beyond just an announcement effect, I'll add as well. We can actually see this performance discrepancy extending into the months after deal completion when we compare M&A to divestitures. So in other words, divestitures continue to outperform M&A even in the months after deal completion. So that pathology is pretty striking, right? So we're basically pursuing very actively exactly the set of transactions that add less value and in some cases even destroy value relative to the type of transaction that we're pursuing much less intensively. So that's the discrepancy that I really see.
That's interesting. Well, surely this is data that's not lost on the activists. They run campaigns that claim management's slow. They're slow to divest. They're slow to realize either changes in market conditions, changes in customer demand or buying characteristics, and that they need to move more quickly to identify divestiture opportunities. Is that fair? A fair critique?
It's a very fair critique. And to me, activist investors, right, there's sort of this characterization of them as the barbarians at the gate, these big evil people who are coming in and demanding change at these poor, helpless companies. And I actually believe it's exactly the opposite, right? I'm quite sympathetic to the activists on this one, I have to say. So it's interesting, right? Why am I sympathetic to them? Because they're coming in and basically getting companies to do what they should have been doing already, right, is kind of the point. Right. And, what's interesting is that, so just to give some color and some numbers around this, a quarter of activist campaigns in and of themselves demand some kind of breakup or sale or divestiture of assets, right, a reduction in scope, right? So that's in and of itself. A third of activist campaigns demand changes in board composition, of which a further half actually result in some kind of scope reduction or divestiture. So we really end up seeing a lot of divestiture activity resulting from these activist campaigns. And then just to put the bow on the present here, right? What's really interesting is that, so I was talking about this average positive effect in general of divestitures on shareholder returns, like announcement effects or longer term shareholder returns. If we actually break that apart and look at the shareholder returns to divestitures that are impelled or prompted or demanded in activist campaigns, what we actually end up seeing is that those divestitures even end up outperforming sort of the run-of-the-mill or the regular divestitures that companies end up doing of their own accord. So again, for me, this just underscores the point that when the activists come in and sort of demand these kinds of changes, companies should have been doing it in the first place. And that's why we see this, hugely positive effect on average from activist demanded or activist impelled divestitures.
Yeah, boy, it's interesting that sort of independent, purely financial perspective that is fresh, right? So devoid of the encumbrances of personal relationships, of history, right? Of ego, brings a sort of different lens that I think again we could sort of take some inspiration from. Sort of to shift gears a little bit in terms of then starting to think about executing, which your book quite nicely does. Sort of thinks about planning and strategy, execution, and post close. So we'll echo your good framework here. So, should we be thinking about the right buyer at the onset, and does that inform some decisions along the way in terms of preparing a divestiture and I'm really intrigued by this emergence of financial sponsors, right? So the private equity has got more interest in doing carve-out deals. Certainly a lot of dry powder. Should one be thinking about that at the onset, or is it sort of, or typically instinctual to have dual track process, right? So whichever party advances the superior offer, but it's offered to the sponsors as well as strategics, and you sort of move from there. Should we be thinking about that up front?
Yeah, it's a great question. So I think of course there's an element of practicality here, right? In the sense of saying, of course, you take the best offer that you're going to get, right? So in that sense, right, it's not too hard of a question to answer. But the nuance, right, or the maybe the twist that I would add to that is, look, some assets are just better suited for kind of private equity or financial buyers, and some assets are going to be better suited for kind of strategic buyers, right? And even further, some divesting companies are going to find themselves a little bit in line with the way that you asked the question. Some divesting companies are going to find themselves in situations where it might be more advantageous for them to transact with a counterparty that's another strategic versus one that's a financial sponsor, right? So if you have, sort of one of these underperforming assets that is, kind of underinvested in within the organization, might a financial sponsor be a better avenue, through which to divest? Probably, right? Because, greater speed, more certainty, faster close, right? All of these sorts of elements, cash on hand for the transaction. On the other hand, if you're in a situation where there is, perhaps some kind of strategic fit or, synergy potential, you might be able to get a higher price perhaps by transacting with kind of strategic buyer, and maybe some of those other considerations are less important, right? So there's kind of this matching effect, I would say, that happens in terms of both characteristics of the assets that are being divested or the divested businesses, as well as characteristics of the divesting company that need to be taken into account in terms of choosing the right outlet, if you will, right, or the right counterparty for that transaction.
And of course, in the book, you remind us too to think about some of the CFIUS implications, antitrust implications, right? So just thinking about that at the onset is obviously good practice as well. So yeah, I think that's helpful to touch on that. So we also have talked about some of the tricky sort of governance issues, and I love that you outside of divestitures look at best practices and governance generally. There's sort of a perception perhaps that isn't talked about that often about, sort of a chance to not only change the composition and maybe an underperforming asset, but a chance to sort of tuck in a few other things, right? A few other assets and liabilities that maybe you don't really want anymore, sort of throwing that out at the same time. That sounds like potentially a trap that one needs to be thoughtful around, and you help us think about fraudulent conveyance a bit in the book. Could you peel that back a bit, and what are some of the top things that should be considered there?
Yeah, for sure. So, it's interesting, right? So, having worked with many companies on this and doing expert witnessing work, right? One thing that I've seen, especially when we look at spinoffs, is that, it can be kind of a tricky transaction type, right? Because as you say, right, there is sort of an incentive at times to, tuck in a few extra liabilities, right, or do these kinds of things maybe that aren't so savory, right, that might not be, so desirable or above the board. At the same time, right, there's also kind of a competing incentive on the part of, businesses that are spun off to sort of, especially when things go wrong, go back and say, well, you set me up to fail, even if nothing bad happened on the part of the divesting company, right? So it's a bit of a, no one can win here, right? Because there's sort of bad incentives on both sides there. So what would I say, right? So, I think, for divesting companies, right, of course, keep it clean, right? Try to keep it above the board, right? And sort of make sure that, assets belong with liabilities and that things are not being set up in a manner that is unfair to the divested businesses. But equally, let's be a bit careful also among the spinoff companies, right, and their creditors and such, especially if things do go wrong, to not sort of falsely claim. And perhaps this is a bit naive in sort of saying, well, look, we have incentives, right, and we have a legal system that kind of creates these opportunities for these kinds of situations to come up. But I think it works in both directions on this point.
Sure. Well, it's like I said, there's sometimes temptations that one needs to be aware of, so the counterbalancing considerations, right? Let's stay on governance for a minute longer too. So, one of the other disputes and sort of post-close claims that tends to come up is to say, boy, the old parent didn't set us up for success, right? And some of that argument is, well, we weren't represented. Now, this is a tricky dichotomy. You've tried to unpack this a little bit for us in the book. Could you explain? So, first of all, maybe set the stage of what is that tension, and how should corporate development teams start to think about navigating that proactively?
Yeah, it's a great question, and so we'll get a little bit into the weeds here on this one, but I think it's an important topic, right? So in spinoffs, right, what's happening, right? So a spinoff, just to kind of give the definition up front, that way it'll be clear, is to say, all right, so we're taking one of our businesses or our subsidiaries as the parent company, and we are doing a pro rata share distribution to our existing shareholders of equity in that new in that business, right? So basically, if you own shares in the parent company, up until the date that the spinoff is complete, right, you will then get shares in the spinoff company as well. And then you can do what you want. You can keep the parent and sell the spinoff shares. You can keep the spinoff shares and sell the parent shares. You can keep them both, or you can get rid of them both, right? So it's your choice. But up until that moment when the spinoff is complete, right, it's the same shareholder base. And so the way to think about this is that, there's one entity here, right, up until that transaction is complete, in the sense that, it's exactly the same shareholder base, right? If you do something to advantage one side of the transaction, or perceive to advantage one side of the transaction, the claim is often that you're disadvantaging the other side of the transaction, but that can't really be the case, because again, the shareholder bases are identical up until that moment of completion. So that's where this all comes from, right? And so to your question about representation, yes, in many spinoffs, what will happen is that a spinoff company, especially one that is failing or having difficulty performance, whatever, will come back and say, well, we didn't have any representation during the spinoff process. We were not allowed to have our own independent counsel, or our own independent bankers, or own independent representation in other manners. And as a result, that means that we were disadvantaged somehow through that spinoff process. And so again, right, we come back to the same point. How can you be disadvantaged because you were represented by the parent company counsel, which makes perfect sense because you were still part of the parent company, again, up until that moment of completion. It's exactly the same shareholder base. So, from that perspective, right, it makes perfect sense that we actually don't see separate representation for the spinoff company in these kinds of transactions. And having crunched the numbers actually for various purposes in my research, right, what I've actually ended up seeing is that I think it's like 2% of spinoff companies had separate legal representation, and 1% of companies had separate financial representation, something like that. But minuscule numbers there. And it's totally appropriate that that's the case because, again, there's this identity of the shareholder bases of these two companies. So, it's a nuanced issue, right? And in a sense, I understand, sort of how one might perceive this to be sort of a conflict of interest or a situation where representation is not being done fairly. But at the same time, right, if you think about the mechanics of what's actually going on in these transactions, you can see that it's totally legitimate and fair that things are usually structured the way that I just described them.
Sure. Well, and maybe this is another good example that obviously explained in the book of these are transactions that create great benefits, and some of the complexities are more myths than reality. Yes. And I think some of that disconnect between myth and reality is because we're not as well practiced. You talked about 70% of companies haven't done any divestitures. And so, on the buy side, we talk about programmatic M&A, and we see high levels of return in terms of really systematic and programmatic M&A. And so you've got best practices that are refined and repeated regularly. It's one of the things we cover in our M&A Academy. It's a good process and good results. It seems more occasional and episodic on the divestiture side. And I wonder how we solve that. Do we solve that by bringing in more expertise that is really savvy in these transactions? Do we solve that by upskilling the corporate development team in the scope and sort of expertise? Do we do both? Are there other things? How do we get better at doing these deals?
Yeah, no, it's a great question, and it really resonates with me. So having looked at some of these data, right? So what I observe, if I were to plot a relationship between M&A performance and M&A experience, right? Corporate M&A experience, you'd see, either kind of an upward sloping line, or maybe at best kind of an inverted U-shaped relationship where there's kind of an increase at the beginning, right? So we do see kind of that positive relationship between M&A experience and M&A performance. If I were to plot the analogous figure for divestitures, you would get basically just a random scatter plot, right? There's actually no relationship between divestiture experience and divestiture performance. So why is that the case, right? It's exactly what you just said, that these transactions are just done much more episodically. So companies never get the chance to build that divestiture muscle in the same way that a programmatic acquirer might be able to build an M&A muscle, right? And to be able to kind of hone those processes for performing well with these transactions. So I think that that's kind of the big discrepancy, right, in terms of the capacity even to get to be good at divestitures at the outset. So to answer your question, right, where do companies get this, right? How do we actually get them to do this? So one solution is what I like to call renting divestiture capabilities, right? So what we observe actually in the research is that when companies hire investment banks, law firms, consulting firms that have transactional experience, especially on the divestiture side, that can help them to enjoy superior divestiture performance, right? So that's the renting of capabilities that I think can be quite valuable. But then, obviously, like just relying on outside parties, right, is not always the most desirable approach to dealing with these kinds of things, right? So I do think there's an element of upskilling that has to happen within companies, right? So hopefully, my book will start to pave the way for this a little bit. But, even further, one thing that we can see is that I think that, I often say this, right, that it's sort of an immense tragedy that we hear about M&A teams, right, in companies, right, in large organizations. And it's sort of like we never really hear the word divestitures, right, or if they happen, there's sort of not a dedicated team or set of personnel, and maybe it's sort of dissociated or divorced from kind of the M&A, practice within the company. And so I think that's a real problem, right? I would actually advocate that more of these capabilities and processes be integrated and held under the same roof, because I think that that's where you really start to get a more holistic view of, what transactions are we pursuing? How do they integrate with one another? How do they collectively advance the company's strategy? And how can we apply best practices maybe, from one type of transaction to other types of transactions? Are there things that we can learn across transaction types, from being on the buy side or the sell side or both in various different circumstances? So So I think that that would be one way, at least, that I would think of to try to resolve some of this gap, I guess, in capabilities that might exist for these transactions.
Well, and I mean, maybe it goes without saying, but I will go ahead and say, having to read through Emilie's book is a great way to get up to speed on the different types of structures that can be used. They all have sort of different characteristics, different pros and cons. And if, again, given the sort of very curious and technical nature of our membership, let's spend a minute on that if we could. We've talked about split offs and spin-offs. We've talked about some of the tax implications, and at least historically, I think one of the things we've seen on our website, for example, a lot of interest in understanding sort of relative merits and pros and cons of a reverse Morris trust structure in particular. RMTs sort of get a lot of attention, but maybe could you give us a feel for the landscape of some of the options that should be considered, and so a quick summary of pros and cons?
Yeah, for sure. Yeah, no, this was actually one of the most fun parts of the book for me to write. I had a good time writing that part of the book in many ways, right? It was a kind of a big learning experience for me. So, so sales are by far the biggest, right? So it's something like 95% of all transactions, of all divestitures, are sales, and so that's pretty typical, right? I'm selling a business, I'm getting cash, right? There's tax implications. Big advantage of sales is that if you're selling something at a loss, of course, you get to take tax loss carry forward, so that can be advantageous as well. And really thinking through, sort of again going back to our conversation about kind of choice of counterparties, that can be a big consideration, especially for that transactional structure, right? So that's the basics. As you said, then we have kind of spin-offs and split-offs, which are those pro rata equity issuances, either to existing shareholders in the case of spin-offs, or to investors more generally in the case of split-offs, right? So an equity offering. And so those are going to be tax-free under certain conditions, right? So that's the big advantage of those transactions. They don't generate cash. So we can think about that as kind of a key situation. The thing to note about them, though, is that the rules of engagement, let's say, around what qualifies to allow a company to do the transaction tax-free, there are some pretty serious and strict restrictions that are in place that need to be minded very carefully in order to make sure that the transaction actually remains tax-free. So that's a big consideration. And then, of course, another consideration is some of the conflicts that we were talking about a few minutes ago in terms of managing relationships between the parent company, the divesting company, and the spin-off company that is being removed in these transactions. So those are kind of the two big ones. Spin-offs are about 3% of the deal landscape if we look at that proportionally. So then there's the whole tail of other types of transactions, right? So you mentioned reverse Morris trusts. So reverse Morris trusts, as many of you probably know, is that combination of a spinoff immediately followed by, or in conjunction with, a merger of the spinoff company with another firm. Right. And so this helps to actually circumvent one of the issues that comes up in terms of making sure that spinoffs are tax-free transactions, which is that there can't be sort of a planned M&A transaction within 2 years. And so what reverse Morris trusts do is that they permit that, assuming that the counterparty to that transaction meets certain technical considerations that don't violate those rules against tax-free spinoffs, right? So that's kind of the point, that it allows for M&A under certain defined circumstances to be combined with spinoffs. And so, very advantageous, of course, from a tax perspective, and very advantageous to investors in the sense of being able to generate value from the synergies from combining the spinoff company with its counterparty in an M&A transaction, in a pre-planned M&A transaction. Obviously, super complicated to effectuate, right? That's the big downside. You have to find the right transaction partner, and there's all kinds of governance issues in terms of how to make sure that the two parties that are merging together work well together, as well as kind of the standard spin-off issues, right, in terms of governance that we were talking about before as well. So that's reverse Morris trusts. Then we have equity carve-outs, which are kind of another way of thinking about how do we, get the benefits of tax-free spinoffs, but still enjoy other advantages that might be valuable, in this case, generating cash, right? So basically what can happen with equity carve-outs is that companies can issue equity in the business that they later plan to spin off or already have spun off, and generate cash from that equity issuance, right? So it's kind of an IPO, if you will. of the spinoff company. So it basically allows the parent company to do a spinoff tax-free, but also to combine that with a cash generating transaction in combination. So that's the advantage there. And then, the last step, right, just taking this all the way to the nth degree there is we can think about transactions like even joint ventures, right? So as a way of thinking about managing kind of a phased exit from a business, and generating cash and potentially avoiding kind of big tax implications all at once, right? So GE is kind of the master of this in terms of using this transactional structure. And then an oldie but a goodie, tracking stocks are another way to kind of effectuate partial divestitures. So, obviously that tail of transactions is, much less utilized, right, than, sort of the big ones of sales and spinoffs. But nonetheless, I think it's really important to understand that there is quite a robust toolkit, if you will, that companies can select from based on what considerations they're trying to solve for and what advantages each of these transaction types have to offer.
So I think we've both excited and maybe scared some of our members in terms of the complexity associated with some of these deals. Now, with that said, I think one of the things we've also demystified a little bit is both the utility and that there are some sort of less complex issues that might be perceived. And it intrigues me to ask, we're always trying to work smarter, right? Are there issues where people tend to worry about, issues that tend to be distracting, but really don't meaningfully impact a divestiture transaction? Much ado about nothing. Anything we should head off and avoid and not waste time on that comes to mind?
Yeah, it's a good question, right? I think that, the stigma issue is probably the biggest one that I would point to, right? I think that, sort of understanding that, no, you're not going to be penalized or viewed as, some kind of loser or failure if you do a divestiture, right? That there's, sort of real opportunities, right? And then maybe on that point also, right, sort of understanding that, divestitures are a transaction in and of themselves, but they're not the whole story, right? And sort of saying like, okay, so this is almost a means to an end, right? In terms of what else we're trying to accomplish, right? So, I think too often, maybe, executives kind of get caught in the weeds of, okay, so this is going to be a ton of work and we're just doing this divestiture and there's no returns, and that's, like maybe there's, some work associated with it. Probably there's some work associated with it, but what else are you going to be able to do after that, right? And how can that help to catalyze your future strategy and where you're going, right, is often maybe overlooked. And so, I think maybe kind of rebalancing that conversation a little bit might be one point that I would advocate on that issue.
Quite like that, and maybe to wrap up, but we our members are all pretty analytical. They're also under a lot of pressure to perform, and they need to often help the board understand the utility that they've delivered, the value on a risk-adjusted basis, and that measurement may not be well established or understood unless it's put forward by the corporate development team. So what thoughts would you have on how might we measure the success of a divestiture transaction and put it in the right light so that it's considered appropriately?
Yeah, I mean, well, certainly for public companies, right, you can go back to what I was saying before and kind of thinking about that discrepancy in shareholder value creation, right? I think that's kind of a headline in and of itself, right?
Sure,
but
sure.
Even beyond that, right, I like to think about kind of resource and capital allocation as, sort of metrics that are maybe hard for outsiders to do, but perhaps easier for insiders, right? Like a corp dev team to really, or even, kind of CFO type folks to execute, right? So what were you doing with your capital, right? And what kind of returns were you getting on your capital across the various initiatives that you were pursuing within your organization before you did that divestiture? And how did that change after the divestiture, right? So I talk about this in, I believe it's chapter 10 of the book, right? Of sort of saying, well, look at these improvements that we can observe, and my research is more at an aggregate level in terms of looking across a universe of companies or a sample of companies. But, one could easily do this exercise, specifically to one organization organization, what are we actually observing in terms of that returns to capital across different investments that we're making, or are the resources that we're investing and putting to use. So I think that would be something that companies could really rely on as I don't want to say a selling point, but sort of a way of maybe conveying the utility or the value of these transactions.
Sure, in a much more fair and balanced way. And I think what you've also just said too is so over a longer period of time than what might traditionally be the metric, in particular on the acquisition side, right? We tend to look at very near-term gains, synergy realization, right? Revenue synergies. We might need a longer-term lens when we look at the divestiture side, but we shouldn't lose sight of not just the financial, but also the strategic value of that cash. It does excite us, and I think I had a great time reading through the book, and I hope we've inspired others to do the same. So obviously, Divestitures is now available. What's the best way for people to buy a copy? Does it matter if they buy it one channel or the other, a little better?
Yeah, thanks so much, William. Yeah, it's on Amazon, so you can grab it there. I think you can also get it through McGraw Hill if you prefer to go through the publishers or bookstores. It should be widely available at this point. So I hope people enjoy and are able to get their hands on it.
Cool. Well, we'll put a link through, so one click, go through and buy it. And I hope others will enjoy it as much as I did. And certainly this conversation, I hope excited people not only to buy the book, but to consider divestiture transactions and to do so with a more informed and more sophisticated lens, which is certainly the aim of the Institute. So Emilie, thank you so much for joining me today. It's been great to connect, and appreciate so much the time and the insights you brought to the community.
Yeah, thank you so much for having me. This was fun. A real pleasure.